Beware the Ides of March. Is the market topping? This article may make me instantly unpopular with many advisors and investors today. But what I'm going to show you today really has to be said. Welcome back to the Local Wealth Professionals YouTube channel. I'm going to try to use the next 5 or 6 minutes to really make you think. If you're watching this, you're probably a mature adult and you have money in the stock market either directly or indirectly through the exploding trend called managed money. If the history of the last 100 years is anything to go on, this could be some very important information for you, perhaps at a very important time. I woke up at 5 a.m. this morning and realized that the middle of March has been a major turning point in the markets a couple of times in my own investing life. Of course, I'm a retired wealth advisor, started buying stocks at the age of 14. I wonder if this time will be different. For fun, let's check out March 2000 and March 2008, a couple of times I remember. You don't have to Google it, I'll show you in a moment. Over the next few minutes, I'll show you a series of charts of the Dow Jones Industrial Average and what would have happened to your money if you had had the ability to be there for the last 100 years and used the information to participate in owning it intelligently. By the way, you'll see too that with a 100-year perspective, Mark Twain was right. It's really nothing to do with March. So what do I mean by intelligently? Well, check this out, then you decide. Here goes. Okay, so here are the charts. These charts are lifted directly out of the Canadian Investors course, the CIC, Session 4 Commentary. What we're looking at is crossing moving averages. So, consider the red curve and the green curve. The red curve represents a 13-month moving average, and the green curve represents a 6-month moving average. When a short-term moving average crosses a longer-term moving average negatively, like it did in 1929, it would be a sell signal. When it crossed positively, like it did in 1932, that would be a buy signal. Then in 1933, another sell signal. In 34, another buy signal. In 37, another sell signal. In late 37, early 38, another buy signal, and so on. You're starting to get the idea. This chart shows clearly that missing the big drops in the market makes an enormous difference to portfolio performance. Now let's move along to the 1939 to 1950 period. Again, volatility in the markets. You see that the volatile period from 1939 to 1940 was a sell. A sell was being set up, followed by a nice buy signal from early in 1943 when the market started to wake up, when the green curve crossed the red curve positively. Then there was this brief hiccup in 1943 that might or might not have triggered a sell signal, but then it ran up nicely all the way to 1946, when a clear sell signal occurred. From then to 1949, the market went basically sideways with a minor buy and sell signals until there was a clear break with another buy signal in 1949. You might also note that although there was some frustrating buy and sell signals that would have triggered activity, this activity did not harm portfolio returns. Now consider the period 1949 to 1960. This was a pretty favorable time in the markets. As you can see, the sell signals were weak ones, closely followed by positive reversals, so following the discipline would have provided little added value over this period, but also it didn't hurt returns. It's as if it was an insurance policy which wasn't called on to pay out. But let's consider the next period, 59 to 1970. That's a completely different situation. There was significant volatility. If this tool offered only minor benefit in the previous decade, it certainly earned its keep in this one. The market finished the decade only slightly ahead of where it started, but using the moving average crosses would have provided dramatically improved 10-year return. If you also look at the next period, 1969 to 1980, same thing again. The 70s, the crossing moving average strategy delivered wonderful returns, while owning the index for the whole time would have actually resulted in capital loss over that same period of time. Well, that changed in the 1979 to 1990 period, when the market was basically flat from 79 to 83 when it started to take off, and the tool didn't really add much value over this 10-year period, but again, it didn't really do any harm either. There was another period there, also using this insurance analogy, where you paid your premiums and fortunately didn't have to use the insurance. By the way, the same thing applied pretty much to the next period, even more so in fact from 1989 to 2000. But when you move on to the period 1999 to 2010, it changed all over again. We were back to significant volatility. The first warning came in 2010 with a collection of weak sell and buy signals leading to 2013, all of which would result in periods of small outperformance. But then the buy signal in 2003 indicated that it said that you should stay in the market until 2007, and it gave us a very clear warning of the 2008 crash, and avoiding that obviously would have been beneficial. Now this brings us to today. Again, another good period, strong period in the markets, strong moving averages, where the insurance policy didn't get a chance to show its true value. So let's summarize the results. From 1929 to 2016, if you had a starting balance of $100,000 in each strategy, in other words, own the index and just ignore it, or use this rule-based strategy which requires more work, you can see that the work was worth the effort. 4.5% annual rate of return for the buy and hold strategy versus 9.27%, a little almost double for the rules-based strategy, but an enormous difference in value because of the compounding over that amount of time. So, if we summarize the 90-year period, the moving average process would have resulted in double the annual rate of return, disproportionately larger accumulated value over the buying period. And perhaps this strategy should be called portfolio insurance strategy. Okay, I've shown you a bunch of charts. Let's summarize. My experience as an advisor showed me that for most people, their real investment time horizon for wealth accumulation was about 25 to 35 years. Also, most people didn't really start to take their money seriously until well after the age 30. So, you do the math on what we just watched. So what did we discover? Over the last 100 years, the Dow had about 20 major corrections and many lesser but significant ones, and it recovered from all of them over time. Every 25-year period had 2 or 3 or more significant corrections. This tool could have been helpful to improve portfolio performance as well. The difference between using it from 1929 to today, or not, was absolutely enormous. The annual rate of return over the whole time period was more than double that of the index using this tool. And with compounding, the dollar difference was so much more than that. Avoiding most of the big drops in any time period would have resulted in a significantly larger total return. Also, using this tool successfully requires self-discipline and personal courage. And people always seem to want to ask the question, will it be different this time? You can see that if you'd known about this tool and had the courage of your conviction, you could have used it to make tactical adjustments to your investment strategy from time to time based on some simple rules that could have improved the outcome of your personal wealth significantly over your lifetime. But I'm not going to belabor the point. If you want, test the theory of your own experience, test my theory on your own experience and compare it to the charts. In other words, the facts I just showed you. Are you a denier? Well, regardless of whether you're a denier or not, I bet you have some questions about what you should do with what you just learned. Well, you could talk to your advisor and see how that conversation goes. As well, you could go to www.localwealthprofessionals.com and learn about your options. Do you want a fresh pair of eyes on your situation, for example? If you like what you watched here, please subscribe to the YouTube channel, watch some of the videos on it, and then tell your friends and family to do the same. The channel is called Local Wealth Professionals. And for us to keep doing what we're doing, we need your support. Local Wealth Professionals is the ultimate source of factual, unbiased information for Canadians to help them become smarter, savvier investors. Thanks for listening, and until next time.